Welcome back to another video. My name is Anthony and today we'll be covering PE ratios, what they actually mean and how to use them to help you decide whether you think a company is worth investing in. Now, please note this is one of many factors to keep in mind when sizing up and evaluating a company and should always be used with other metrics of which we'll be listing in upcoming videos. Now, what is a PE ratio? Price to earnings ratio. The price to earnings ratio, or the PE, is one of the most widely used metrics for investors and analysts to determine stock valuation. In addition to showing whether a company's stock price is overvalued or undervalued, the PE can reveal how a stock's valuation compares to its industry group or a benchmark like the S&P 500. The price to earnings ratio is sometimes known as the price multiple or the earnings multiple. This is the ratio for valuing a company that measures its current share price relative to its earnings per share, or EPS for short. Now, how does this number get calculated? To get the PE ratio, you take the share price, or the market value per share, and divide that by the earnings per share. This will give you the PE ratio. So, we have quickly covered the definition and meaning behind the PE ratio. You may be thinking, okay, but these numbers are still meaningless to me. What is a good PE ratio for a company and how does that translate into the real world? The PE ratio shows the current investor demand for a company's share. PE ratios are used by investors and analysts to determine the relative value of a company's shares in a like-for-like comparison, especially in same-sector comparisons. A higher PE ratio shows that investors are willing to pay a higher share price today because of growth expectations in the future. The average PE for the S&P 500 has historically ranged from 13 to 15. So, a company with a current PE of 25 above the S&P average trades at 25 times its earnings. However, a stock with a high PE ratio is not necessarily a better investment than one with a lower PE ratio, as a high PE ratio can also indicate that a stock is being overvalued by the market. A key example of this is Amazon, with a current PE ratio of 103. They have had over 1,000% of growth during the past 10 years, but many investors are of the opinion that this kind of growth cannot last forever, or at least continue for another 10 years. But as you can see, this has not been reflected in the PE ratio, indicating a highly valued company, but with some doubts over its sustainability of its aggressive growth curve, this has still not impacted the PE ratio. On the flip side, when a company's stock has a low PE ratio, it may indicate that the stock is undervalued. Investors can often buy undervalued stock at a discount and then profit when the price of that stock climbs. That said, sometimes a low PE ratio reflects a genuine lack of growth potential or show a lack of popularity for that particular stock pick. For example, Carnival Corporation, or CCL for short, has been hit hard during this current crisis, and this has been reflected in the PE ratio currently standing at 4.26, as it is unclear whether they can survive this current situation and get back to consistent profits. So, now that we have covered the definition of a PE ratio and how to use it, here are some key points to take away. A PE ratio is one of many key performance indicators that investors and analysts use to measure up whether a company is fairly valued or whether or not to invest in said company. It should not be used solely by itself to decide whether you should invest or not. And always remember, a low PE ratio does not necessarily mean that a company is a good buy. This can reflect genuine negativity. I hope this video has helped you. If it has, drop a like, comment and subscribe, as this will help us make more videos in the future. Thank you very much, and I'll see you soon.